Let's jump right into this explainer with a scenario that honestly sounds like a cruel joke. I want you to imagine the unluckiest investor in history. We're not just talking about someone who's a little bit bad at timing the market. I mean someone who is historically almost impossibly bad at it. You are the exact investor that financial textbooks would invent just to scare people. Picture this. You only ever put your money into the market at the absolute peak, right before major crashes. Every single dollar you deploy goes in on the exact day the market hits a brand new all-time high, literally the top of the mountain right before the inevitable massive drop. You invest right before the dot-com crash of 2000, before the absolute collapse of 2008. You buy at the peak right before the COVID plunge of 2020, and then again before the massive sell-off of 2022. So after 20 years of watching your portfolio absolutely crater immediately after every single investment, what actually happened to your money? Well, the answer is backed by decades of data, and I promise you it will permanently change how you view market highs. We're basically looking at two totally different investor archetypes here. First, we have Patrick, who is sitting on a pile of cash, completely paralyzed by market highs. Every single record feels like a giant flashing warning sign to him, so he just stays in cash. But then we have Simone. Picture an elegant, professional Asian businesswoman standing in a modern, sunlit corporate office. She completely radiates this inspiring aura of trust, prosperity, and true financial freedom. She isn't stressed at all. Why? Because she operates with a completely different mindset. She simply automates her investments on a fixed schedule, totally ignoring whether the market is at a record high or a massive low. To figure out who actually wins, the cautious waiter or the automated investor, we really need to look at this fascinating 2021 study by the Schwab Center for Financial Research. They put together one of the most cited studies on investment timing out there. They basically tracked a 20-year period of S&P 500 data and set up this hypothetical experiment testing 5 different investing strategies. For each strategy, the investor had $2,000 to invest every single year. The final values after 20 years are going to completely flip your expectations. Okay, so perfect timing. The mythical investor who always bought at the absolute bottom ended with roughly $151,000. Immediate investment and dollar cost averaging hovered just below that. But check out the bad timing row. This is our unluckiest investor, the one buying exclusively at the yearly peak. They still ended up with over $121,000. And then look down at the bottom. The person who never invested, who stayed 100% in cash waiting for the perfect moment, they ended up with just $44,000. That right there is the crucial takeaway. The difference between having the absolute worst, most impossibly bad timing in history and just staying in cash was nearly $77,000. Being the literally worst market timer still produced almost 3 times the wealth of the person who just played it safe in cash. Patrick's caution is costing him dearly. He's paying an invisible, compounding price every single month he sits on the sidelines. But why? I mean, this kind of violates our common sense, doesn't it? Mechanism 1, the frequency of highs. Let's break down exactly why this unintuitive data is actually true. So, according to research from Ben Carlson analyzing U.S. equity market data, approximately 30% of all trading days in history are all-time highs. That's 3 in every 10 days. During bull markets, a new high is set roughly once every 2 weeks. We're taught to view all-time highs as these rare, dramatic, super dangerous warnings of an irrational bubble. But they aren't rare warnings at all. They are just a completely normal, routine part of a healthy, growing market. If you wait for a pullback every single time there's a new high, you're essentially going to spend a massive chunk of your investing life sitting in cash, missing out on huge growth. Most of the time, an all-time high is literally just a Tuesday. Which brings us to mechanism 2, trajectory and time. This completely reframes what a market peak actually means. Think about the long-term trajectory of the market. Back in the year 2000, at the very height of the dot-com bubble, the S&P 500 hit this terrifying, wildly overvalued peak of about 1,500. Analysts were screaming that it was a bubble, and honestly, they were right. A brutal crash followed. But look at where we are today. In recent years, the S&P 500 blew past 5,000. That terrifying, towering peak from the year 2000 is now just a tiny fraction of today's market. It proves this fundamental law of long-term investing. Because underlying businesses grow and the global economy expands over time, today's ceiling basically always becomes tomorrow's floor. And hey, this isn't just a fun anecdote. A 2014 Vanguard study actually analyzed the S&P 500 going all the way back to 1926. They found that the returns in the 12 months following an all-time high are statistically indistinguishable from returns following literally any other market day. So an all-time high actually holds zero useful predictive information for near-term returns. Knowing the market is at a record high tells you absolutely nothing about what's going to happen next month or next year. And that leads to mechanism 3, the brutal math of compounding. Every single day you sit in cash, maybe earning a safe 5%, the uninvested money is out there compounding at historical equity returns closer to 9.5%. Over a single year on, say, $100,000, that gap feels pretty small. But compounding isn't linear. Over 20 years, sitting in cash turns $100,000 into $265,000. But being invested, that turns the exact same amount into $628,000. By waiting, you're permanently shrinking the foundation upon which all your future wealth is going to grow. Complications and nuance. Before we wrap up our main takeaways, we really need to look at the realities here. First off, a lot of this data relies on U.S. equity markets, which have obviously seen historically extraordinary growth. Just look at Japan's Nikkei, which spent decades stuck below its 1989 high, and you quickly realize why geographic diversification is absolutely essential to mitigate single-country risk. Second, we can't ignore the psychological toll. Sure, the worst timer wins the math game over 20 years, but living through a 30% drawdown, literally watching a third of your life savings vanish on paper, is emotionally brutal. You need serious stamina to not panic sell at the bottom. And lastly, your time horizon is everything. This strategy relies on decades of compounding. If you actually need this money in a 2 to 3 year window, timing matters a whole lot more. The actionable solutions. How do everyday investors actually fix this and adopt that wealthy mindset? There are 3 really straightforward steps here. Step 1, reframe what a high actually means. Stop seeing it as a warning and start seeing it as evidence of normal, healthy market growth. Step 2, if dropping a huge lump sum into the market at an all-time high gives you unbearable anxiety, just use a structured plan. Deploy equal amounts over 3 to 12 months. Dollar cost averaging is just dramatically superior to doing nothing. And step 3, which is absolutely crucial, automate. Emulate Simone. Let the calendar decide. By automating your investments, you remove the paralysis of fear entirely. You don't have to wake up and make a brave decision every month. You just let the math in the system work for you in the background. Ultimately, almost a century of history proves that your caution is costing you money. The market hitting an all-time high is really just proof that the underlying economic machinery is actually working. The best time to invest wasn't before the last high, and it definitely wasn't during the last crash. The data strongly suggests the best time to invest is almost always simply right now. And the second best time is exactly the same as the first. Which leaves us with one final, pretty provocative thought. If trying to perfectly time your entry into the market doesn't work, and even the worst possible timing beats staying in cash, what variables actually do move the needle on your long-term wealth? What should you be focusing your energy on instead? That is exactly what we'll be diving into next time.